Hello, YouTube. Are the Bears about to make a big mistake like they did in 2008, where for 10 weeks in a row we formed higher high after higher high after higher high, and then we finally went down after 9 weeks? Over here in 2022, we have 4 weeks so far. And what might be a little bit controversial this weekend is that there is a lot for us to make up, and we have to actually get above 390 to actually print that weekly higher high. So that is the mistake I think the Bears might make this week. We could absolutely go down, but in my opinion, I think that there is not very many people who are actually looking for that upside potential, which means that might be our current scenario. I also say that because there's currently greed in the market. And even after Powell told us, he pounded the table over and over, people are still greedy. We're down by 3% on SPY, multiple percent on individual names in the last 1 week, including Microsoft down by 6, Apple down by 11, Google down by 10, Meta down by 8, Amazon down 12, Tesla down by 9. The last soldiers, or the NASDAQ, are really truly starting to soften up here. So when we think about this fear and greed and we look back to the chart, I now want to point out one thing which is happening in 2022, which is telling me that the Bears might just not be the best positioned in terms of timing. And I say that because when we now look to our CFTC data, which is going to include net speculator short positioning for the S&P 500, we note that we're now back to 170,000 contracts short. It looks like we're actually starting to reduce the net exposure. And we've been hovering here between roughly 100 and about 220 ever since we hit late September, early October. So look at these two periods right here. We got September 30th and October 10th, and that's the only times we actually went back below 200,000 contracts short. Where is that? Let's look on the chart here. So the end of the month is going to be right here, which is where we closed out our weekly candle on the 200 MA, and then the 10th, which is basically where we closed out the MA again. So the only two times we actually closed on or below the 200 moving average, which is currently at about 360, or our June low, is where the shorts were covering. And now that we actually have a move higher, and they're reducing, it tells me that, hey, well, maybe we're going to go a little bit higher so they can reload closer to 400. So right now, that's really what it tells me. It tells me that they might let this melt higher for the next couple of weeks so that we can ultimately go to where we're supposed to. One more really important thing for us to look at, we're going to look at time here, because I think this cycle is going to be Fed driven. And if we look back to 2008, to where we formed our top, it is 9 bars later. Where are we right now? What would 9 bars be from here? Oh my goodness. 9 bars for us would be December 12th. Why does that date matter? This is where it starts to get very obvious for me, but timing is still the issue. We have the Fed meeting on December 13, 14, or the next time there's an asterisk. The asterisk tells us that this is a meeting associated with a summary of economic projections. So one more time, let's go back to this. The FOMC, or Jerome Powell and the Fed, in 9 weeks from our low, are going to tell us that interest rates are likely going to be going higher, which means the market likely needs to go down. And the market is likely going to wait all the way until we actually hear the evidence. It's going to be surprised by it, and then we're going to reprice. So at a very high level, that is what I'm looking at this week. One more time, 9 weeks out from our 2009 low, if I'm correct, that is where we're going to form our top. And 9 weeks from now takes us out to the week of December 12th. So on December 12th, that is where I believe that is where we're going to fight to know whether or not we're going to go higher or lower. And if we continue to form weekly higher highs all the way into here, by the 8th week, we do form a slightly lower high, but then we resume to higher highs and then just lower highs after. So that's really what I'm paying attention to. So if the Bears are able to get us back below 373 and then crack us to a new low of the week and we fail to print the higher high, I could be wrong. I could be wrong about us forming higher highs. I just happen to think that with the greed, with the positioning, with the messaging from the Fed, but then also a few glimmers of hope, the market could melt higher. So what exactly did Jerome say, and why is doomsday coming in about 6 weeks? When Powell makes doves cry with disappointment. Cool. The Fed has been misunderstood before, but shouldn't be this time. Investors need to stop imagining pivots that will only lose the money. There you go. Powell, it is premature to think about a pause. What does that mean? We're not pausing. It's premature. And now Larry Summers, who has been very accurate in calling predictions for the Fed, tells us that there is a risk the Fed needs to hike past 6% to curb inflation. Right now, the market's only really pricing in about 5%. How do we know? Fed swaps price in peak policy rate at 5.25% for June. So maybe we have to go even higher than we're priced right now. And the Fed is still pricing in, the market is still pricing in cuts for 2023. I think that needs to get repriced if Jerome tells us in December that they're raising their forecast. And we already have a preview here. Fed officials eye further rate hikes with possible peak above 5%. Barkin says Fed must do whatever it takes to curb inflation. Collins says it's premature to call the peak, but it's moved up. There you go. That is why this week really matters. In addition to that, we also have pro traders and algorithms have overrun the fast twitch option market. So when we think about why would this be so choppy, and there's not really that many more percent gains until we get to the top, but it's super volatile. Like, oh my goodness, like we're almost discover the whole range for these couple of weeks here. We go from low to high, high to low, low to high. It's like really choppy. But we're going to read this article really fast here, and it's going to maybe provide some context in terms of the wild swings we are seeing. Frenzy trading in 0 DTE or 0 days to expiry option goes beyond retail. So what we're going to do is zoom down to the bottom of the article here. I'm going to read these couple of paragraphs. What does it mean for the market? While not unanimously accepted, one narrative holds that the explosion in options trading causes derivatives to amplify moves in underlying assets, potentially creating market dislocations. The group at the center of this option dealers who take the other side of the trade and must buy and sell stocks to keep a market neutral stance. The theoretical value of stocks required for market makers to hedge the directional exposure resulting from all options activity is known as delta. Breaking all 0 DT option trades into 5-minute intervals, Chang and his colleagues then plotted their deltas at trade imitation against the SP 500 performance. In short, the team found that over the past month, the market impact for those traders can vary from a drag of about 0.6% to a boost of about 1.1%. So right now, with greed high and positioning being very clear, that is how we can form these really wide ranges, and we can have extreme volatility on a day-to-day and a week-to-day time frame. All right, let's move forward with the rest of the show. Why could we go higher, Justin? Tell me, because I just don't see it when I look at the charts. We're closing at the low of the week with a bearish engulfing candle. How is that bullish? All right, let's go. Analysis: China's market clutch at economy reopening straws. Again, keyword there being clutching at straws. Let's read one line here. It tells us that showing how desperate investors are for an end to months of relentless negative news. That is right. They're getting greedy on the hope, maybe misplaced, that the market could be going higher. This is also really interesting because on Tuesday, we're going to hear from China in regards to their CPI and PPI, and then we get American numbers on Thursday. So why does this matter? Well, CPI is going to be going up. CPI is going to be going up a little bit less than forecast. However, this PPI or producer price index is going to be a negative number. That means a contraction, and that would be quite a negative. Why? Because it means the second largest economy is starting to contract. Would that be a reason for China to potentially look at reopening? I think so. Is it ill-guided? Well, I think we're going into winter. I think after fall comes winter, but it doesn't mean people can't hope and pray for some good news. And then as we shift here to what's going to be coming in on Thursday for American markets, we got CPI and we also got core CPI. So the core CPI is expected to come down versus the previous period. Same thing with CPI on a year over year. And then month over month expected to actually tick higher. So I believe that if these numbers come in as forecasted, that's going to create a false hope that the Fed is going to pause and that we could be going higher. There we go. And then also on Tuesday, we have U.S. midterms. So on the same day, we're going to get that CPI and PPI number. I don't know what the results of the election are. I believe that we're going to get some relief into the election and then after it. That's just what I think. So there you go. At a very high level, that is what I think the markets could do this week. Now we're going to look at a few weekly charts to try to get a good understanding of where we're going to go. All right, so looking here to the SPY on the 1 week chart, we note that we have two downtrends. We got our first one and our second one. So the onus is 100% on the bulls to break us bullish. What does that mean? We have to get a weekly close back above 384. This 384 number is so important because it corresponds with -20 off the all-time high, or where a bear market is defined. So if there's going to be any more relief or a move towards 390 on the weekly, and God forbid 400 in the next couple of weeks, we have to get a weekly close back above 384. Have to. It's not a nice to have. It is a must have. I would also note that the low for this week is 368.79. So a higher low would really be around 370, or forming a micro inverse head and shoulders here on the weekly. Last thing, the line in the sand for me, or the pink line, or the pivot, is 362.17. And that is where our 200 weekly moving average is likely going to curl up by one more point to meet us there. So if our June low is the must hold area, and then we got our October low after that, this is like a really important area. And if I'm wrong, and the bears do take control of the chart, that's likely where we're going to go pretty fast. Volume is already pretty elevated, but because the shorts are actually covering, I believe that we could still have a little bit more of an upside move. If we now look at QQQ, or the Qs, this is a lot less bullish. And it's a lot less bullish because this is our second weakest close, going all the way back to, what is it here? Second weakest close going all the way back to July of 2020. That's right. One more time. Second weakest close, only stronger than our October 52-week low. And that's like a long time. That's a year and a half away. Why? Well, we showed you that the heat map and technology stocks in the last 1 week have been getting absolutely clobbered, which means that people are getting ahead of the selling. And these moves are dramatic because these are multi-trillion-dollar companies. There we go. QQQ is definitely a drag, and we're not even able to get back above our June low. That's like really important. Moving on, we're going to have a look now here at the DXY, and the dollar now is actually also closing green on the week. If we get more hope out of China reopening, I think that could cause more of a continuation move down for the dollar, but we don't quite have that confirmation yet. As I just noted, we're actually closing green on the week by about 12 cents. This is an inverted hammer, which means that we might start going down. I would be watching a key area here at about 110, and below that, we got 106, which is going to be a multi-decade area we're watching for our head and shoulders going all the way back to the 1980s, or the Volcker era, which is what Jerome Powell is really talking about lately. If we look at the VIX, VIX is also coming down, which means that the market is getting less volatile in a period where we're getting greedy, which means let these guys get greedy, let them buy, and then absolutely destroy them. US 10-year, 2-year note going up by about 5.4% on the week, penetrating through 5. 10-year note closing up by about 3.6%, has a tight inside bar or a flag. Are we going to go higher or lower? TBD. Let's see. This is also what's going to be causing a lot of pressure for tech stocks. And then as we look forward here to a couple of other risk assets, so with the dollar being down, what was really interesting to me was just that we're now actually forming a move higher on other risk assets, but tech is not following. So when I look here to gold actually closed up on the week by about 2%, closing at the high of the week, but just below its 200 MA. And this is a really important pattern because going all the way back to the 1980s, if we switch this to a log scale, it looks really similar to what happened here, where we backtest our 200 weekly, and then we move higher. So our current cup, which we have right now, is backtesting the 200 MA. And if we can reclaim that, it likely means we're going higher. So people are definitely buying risk. They're just not buying risk in terms of stocks. When we look at crypto as well with the soft dollar, it's moving higher by about 3.3% in the week. It is now over last week's high at about, last week's high is 21,000 basically. So we're up by about $300 over that. And then ETH is also butting up against its 1700 area or its resistance from a relative low. So that's where we're looking at on the risk spectrum. And then if we look to a couple more charts here, we're going to look at the trillion-dollar companies next, because these are really the companies that could either make or break this next leg on the SP 500. As we just noted, they are deep red. I'm noticing that they're all either battling for a zone. So here we got September of 2020 up to our high here in August of 2020. And it went right off the 50, right into the bottom of the demand zone. So if we fall out of this area and print a weekly lower low at about 130, 133, I think Apple could be headed to its 200 weekly, and that's at about 110 right now. So watching Apple pretty close here. Looking at Microsoft, already on its 200 weekly. Volume is elevated. It's actually slowly creeping up. So that tells me that sellers are starting to dominate. Looking for support to be here at about 190, going back to our March of 2020 high. Google blew through its 200 weekly, elevated volume. That is not bullish. We're now looking all the way back to prices from September of 2020. So this one's definitely a drag. Amazon, there we go. Amazon's all the way back to levels that we're basically looking at going back to 2018. Already blew through the highs from 2018, 2019, and 2020, and is now looking for some support around the lows we established in early 2020 when we all know what happened. What does that mean? The whole lockdown has been basically a mountain for Amazon, right? Bullish at the start, negative at the end. Is the mountain going to turn into more? Let's watch close. Tesla's still holding up really strong, just like Apple around its relative lows. Oops, let's go back. Right around its relative lows at about 200, 210. I see potential for us to go back to the August of 2020 high, which is currently right around its 200 MA as well at about 160. So watching Tesla closely with a potential move back down to 160. And then Meta, oh my goodness, down by more than 70% year to date. And this has been getting absolutely wrecked. We're now looking at prices we haven't seen since about 2016. So Meta or Facebook is definitely leading the decline. Volume is ramping up stronger and stronger. And this is not the sign of a healthy chart. So with that said, I wish you guys all the best of luck for this next week. If you want all of my regular notes, which I would provide in addition to what we talked about today, click on the link in the description where you can join me, Justin, and trade with me this week to see how I'm going to take these notes to formulate a plan and try to get an edge trading in the stock market. Otherwise, I wish you a terrific trading week, and I look forward to seeing you in the next video. Thanks so much.